Well, greetings everyone. It's summertime. Welcome to the August 2020 Investment Strategy Brief, which we keep calling these days the COVID-19 update. You know, when we look back to the beginning of this pandemic, we were focused on what we thought of as sort of flattening the curve. We didn't really know what that meant, but it came down to slowing the spread of the virus to keep the healthcare system intact, not overloaded, and also buying some time for medical innovation. So a few months ago, this chart was a little confusing. Now I think it's all second nature to most of us. When we also look back a little bit in time, we remember when the CDC and the White House came out with a reopening plan. The idea at the time seemed interesting, but also relatively high level. The concept was look for 2 weeks of improvement on things like symptoms, actual cases, watch the hospitals, make sure that they're under control, and if you see 2 weeks of improvement, take a step. And they actually defined in their sort of framework 3 phases of reopening. Obviously, in today's environment, as we look around the country and around the world, within states, even counties will have specific plans. And so everybody's taking these concepts, but are implementing them in much more granular and frankly complex ways. So we're all watching the reopening very carefully. And in fact, this data kind of captures half of the states, sort of the worst half in terms of how they're doing, quantifying things like cases and symptoms and the hospital capacity, et cetera. And of the 4 criteria that the government was looking for, how many criteria is each of the states meeting? And essentially you can see here a variety of results. What I find interesting, I live in New Jersey, and right now New Jersey, you can see at the bottom of this page, so if we turn to this next page, these are the states that are better off and doing better. At the start of this kind of monitoring, New Jersey was basically the best. And so one of the things that tells us is that states can move around a lot. The data is moving very quickly. It's good news is while we had some outbreaks in places like Florida and California and a couple other states a couple, 3 weeks ago, it's really sort of improved over the last few weeks, and things are on the margin getting a little bit better. Now, obviously, what we're trying to do is keep the virus under control while we let the medical innovation unfold. So there's therapeutic work going on, over 300 companies pursuing that type of thing, and over 200 companies pursuing vaccines, with 8 of them in phase 3 trials at this point. So the view is sometime, hopefully in the fourth quarter, maybe early first quarter of 21, we'll see a vaccine approved, and many that are sort of front runners are actually being pre-produced, so we'll have lots of doses ready to go once they're approved. So again, we're all watching that very, very closely. In terms of what's been going on, obviously when the virus first hit and the shutdown hit, that really impacted everything negatively very quickly. So we saw things like retail and food services sales fall dramatically. We saw unemployment jump up. We saw things like PMIs, which are sort of forward-looking surveys from business managers, fall below 50, meaning contraction. So on this chart, sort of the top 3, for example, then we're seeing recovery. So in the last few months, basically, retail and food services sales are up, unemployment is falling, and those PMIs have made their way back up to the sort of pre-virus levels. Now, another thing we're able to track is mobility. Basically here, these days, we're able to pull data. This happens to be from Google. I think of it as anonymous data, our metadata being stored there, and they're able to watch with all our phones what everybody is doing in terms of mobility. And so a couple things to note. When it comes to transit in workplaces, the 2 lines at the bottom of this chart, basically we're operating at around 35-40% below normal. And if you're like me, I'm operating remotely. I'm working from home, as is most of my team, and we're not using transit to get to work. So it's not surprising that that's kind of below normal. And we'll track it to see as things reopen slowly but surely, things going back to normal. But then I think, interestingly, the gray bar is parks. So the idea here, in my opinion, is, boy, everybody's cooped up. Once they opened the parks, everybody jumped out and wanted to get outside just to get some fresh air and kind of calm their nerves a little bit. And the bottom line is we're operating, about 50 to 60% above normal in terms of the use of parks. Now, here's a bunch of data. It's what we call our coronavirus dashboard. Essentially, it's a bunch of data that I worked with my team to identify where we wanted to monitor the impact of the shutdown. And, the good news is if you look on the right side of this chart, anytime you see a green sort of arrow pointed up, what that means is that that particular data point has gotten back to pre-virus levels. So I was struck when I asked the team to add that we're seeing it a good amount. Now, when it all rolls together, though, GDP is expected to be down about 4 to 6%, a contraction for 2020, both here in the U.S. and globally. But we're seeing recovery in places like manufacturing and even services, as measured by the ISM PMI, for example. Now, this next chart is just the extension of that dashboard. And, I think probably the most important thing to note is as of last night, as I recorded this, the S&P got back to a new record. So the S&P's recovered fully, and we'll get into that. Now, one of the reasons the markets have held up well is the unprecedented, really historic policy response from both the Fed and the federal government more generally. Monetary policy with rates low, the Fed stepping in with a lot of loan facilities as the lender of last resort, and then stepping in with their balance sheet and participating in certain markets, providing liquidity there. On the fiscal side, that sort of coordination of legislation between Congress and the White House led to very quickly two fiscal packages totaling almost $3 trillion. We all know the story there. Money into the hands of individuals, support for small businesses, support for the unemployed, so higher unemployment benefits, things like that. And basically what's going on, of course, now is that the government, Republicans, Democrats, and the White House, they're all negotiating what will be the next package. In the meantime, while it may be challenged legally, the president has signed 4 executive orders, in part to continue some of that support in terms of unemployment benefits, et cetera. So again, we'll see how that all unfolds. But again, lots and lots and lots of support given the shutdown from coronavirus. This is what we call our macro markets and themes page. It's really a look under the hood, the kinds of things my team's focused on. I mentioned the presidential executive orders, for example. We're sort of tracking a number of different things here. What I would point out generally on this page is that the headwinds and tailwinds through 2020 have quickly become focused on coronavirus and the impact of coronavirus. The other thing I'd mention is that we tend over time to identify mega themes. So a couple that I'll mention here. One is sort of geopolitical tensions and protectionism, in part because of the virus and sort of the risk of supply chains. We're finding countries turning inward. They want to become more self-sufficient, so they're a little less globally minded than maybe they were 5 or 10 years ago. And so that's an important trend that we're watching. Another is what we've called the fourth industrial revolution. So it's the World Economic Forum's sort of coined phrase, but basically the idea that innovation is here because of technology and the power of computing. And that certainly is even more true today. The way that has helped with remote work and communication has been quite striking. And we expect all of that certainly to continue. Now, in terms of the markets, here's performance for 2019 and 2020. And a few things to note. I mentioned before that basically the S&P 500 has earned its way back and has set new records since the low back earlier this year. The other thing that we added to this chart was an equal weighted S&P. So there's lots and lots of talk about the idea that the bigger companies, especially tech, are the strongest performers this year. And that kind of plays out. If you include those with their market weights in the S&P 500 index, that's been supportive of positive returns. When we look at the S&P constituents on an equal weighted basis, so you take away the effect of the largeness of those companies, then you can see, for example, that the year-to-date number is negative. So it is the case that the bigger companies have done better, and we're all sort of watching for a rotation in a different direction. Now, from a valuation perspective, we always track price-earnings ratios. So the blue lines on this is both the U.S. market and non-U.S. market on the bottom of the page. We're going to track this against historical levels. And interestingly, the price-earnings ratio, both on a backward-looking basis and a forward-looking basis, is very high, meaning markets are richly valued. But I point out a couple of things. One is that earnings, both looking back and looking forward to the next year, are really eroded quite dramatically on a very short-term basis, the idea of the shutdown and then the recovery. And we'll look at some expectations in just a second. So the bottom line is what we really think is going on is the markets are pricing longer-term earnings. So the fact that these price-earnings ratios are elevated are notable, but not overly concerning. Another way to check that is to look at what's called the earnings yield. You reverse that PE ratio and look at how earnings as a function of price on a percentage basis. And in this case, we're subtracting then the 10-year Treasury yield. And what this is showing is that stocks are a very good deal when it comes to investing in them relative to investing in the 10-year Treasury. Of course, that's in part because Treasury rates are lower, and we'll take a look at that. Now, another thing we pulled out this month was fund flows. So one of the things you always want to check is when markets are going up, is that driven by money kind of chasing the markets net, or is money flowing in, demand is up, and that sort of bids up the price of the market. What this chart shows in the bottom right here at page 18 is, in fact, when we look at U.S. equity funds and ETFs, basically in the last few months, there have been outflows out of the market at a time yet when the market remains positive. So it isn't driven, in our view, by sort of a significant net demand in equities. Now, this chart is super interesting because basically what we know about the equity market is that we go through these bull and bear market cycles. This goes back basically to the Depression, severe moves before and after back then. But then, since then especially, basically the market goes up a lot for a sustained period, and then we see a short bear market usually falling less than that rise had been, and then it sort of recovers and a bull market kicks off. And what's been interesting is this recent move here earlier in 2020 was probably one of the shortest bear markets on record, and we've just turned the corner, meaning we're now back in a new bull market. And again, so very, very quick moves. And as we move through time and these current events move to the left of this chart, it's going to be interesting because those sort of windows of time are going to be very slight. You're going to be very sort of narrow and thin bear market there, what we just experienced. Now, in terms of that S&P recovery, this has been sort of something that has proven out over time. This happens to be the 15% down moves in the S&P 500 since back to the 1920s. And the idea is, okay, let's look at the magnitude of that move and then the subsequent 12 months and how did the market do? In each case, kind of by definition, the market recovered. But every time you see a green bar, the market recovered fully within 12 months and usually before 12 months. And then if it didn't recover, the bar is still gray. We give you a sense for the length of time that it took for the full recovery. But check out the bottom. Again, just with the last night's close, we're able to update the current recovery bar to green, meaning it's fully recovered. And it basically took 5 months to do it. So we're going to talk about sensitivity in the markets and the risk of a downside move. But so far, that news has been good. Now, I mentioned earnings. The upper right of page 21 tells the story of what the market participants' consensus, the view was at the beginning of the year. Those green bars were sort of the world, the innocent world pre-virus, and what people were thinking about earnings growth. And basically the view was it was going to be reasonably positive in 2020. But boy, with the shutdown corresponding to COVID, essentially earnings have taken a hit. Those first two blue bars are actually, the first one is pretty much what happened in the first quarter. The second quarter is about, 85-90% in. So it's mostly the result of actual results, although a few companies still have to report. And then what we expect on a consensus basis is for earnings to recover. So what I mentioned was earnings got hit super hard. It certainly is a shock to the system, but there's a view in the market that earnings are going to recover relatively quickly. Therefore, valuations have remained pretty high. Now, here's a chart that breaks it down in terms of the sectors. And essentially what we're going to see here is that relative to even just a few weeks ago, end of June, essentially utilities, healthcare, and tech are better off and all positive as it relates to year-over-year second quarter growth. And so that's interesting and good news. Obviously, a lot of sectors have been negatively hit. And you'll note some of those sectors, for example, have held up in terms of performance because of those earnings results. Now, here's a chart that's new this month. Basically, we wanted to ask ourselves the question, with all this focus on the bigger tech companies, how much are we lining up for a potential correction like we saw in the dot-com bubble? So some interesting parallels. Right now, both the current big tech companies and the dot-com companies represent and correspondingly represented about 25% of the market. And yet when we look at the price earnings ratio of the big tech companies, it's much lower, meaning it isn't overvalued relative to what we were seeing with the dot-com bubble. I think the biggest and most important thing, though, is earnings on the upper right of this page. Basically, net income of these companies is strong and positive and growing. Back in the days of dot-com, we saw valuations attached to companies that yet weren't making money, weren't creating positive earnings. So it's a very different dynamic. Maybe they're a little overvalued, but we don't think we're in a bubble. Here's another new chart, which is really just tracking both gold, which people are very focused on as a safety asset, and the US dollar. Oftentimes they move kind of against one another. And here what we're seeing is that that's kind of happening where gold is up a bit this year and the dollar is down modestly. What's been interesting about gold is we think it's pretty reasonably to richly valued, but it's of course a decent investment for a small part of a portfolio if one believes that we're going to see another bear market. So it's gotten a lot of attention because of those defensive characteristics. Now, I mentioned rates being low. That's obviously anchored on the Fed funds rate. So I mentioned the Fed bringing rates to near zero. They basically have done that. They're signaling they're going to keep rates there for a while. And that means that there's no reason for the market rates to go higher. So the Treasury rates have fallen. They've kind of bounced around corresponding to this low level of rates. They've come up a little bit recently, but they've stayed pretty low. Now, turning to the economy, this next page, page 26, basically shows, the print for second quarter, severe negative number. And again, remember these numbers are on an annualized basis. What I always like to point out, and we've decomposed the components of GDP for second quarter, that consumption, that means the consumer, is a very significant part of GDP. We've been talking a lot about that. And of course, that's been impacted, the consumer, by the job market. A lot of people lost their jobs. Unemployment rate, it went way up. It's coming down, but still above 10%, which is quite striking. Jobless claims, some good news, is finally fell below 1 million, which is good, the weekly jobless claims. And so we're kind of tracking this. The whole idea with the reopening is jobs come back. We're going to be tracking that very, very carefully. It's going to be a lot about innovation in the medical space, vaccines, therapeutics, et cetera. On the business side, bankruptcies are inching up. Again, we're watching this pretty closely. In general, not a huge volume, but still, something to be watching. And then similarly, we're seeing even good companies cut or suspend their dividends or their buyback programs. So here, so far in 2020, we've seen 65 of the S&P 500 companies cut or suspend. We saw those levels back in the financial crisis. What's interesting about this environment, again, is it could be very good companies just deciding to be a little bit defensive. So I mentioned the overall effect now, that's the businesses. Now, when we look to GDP, again, what we're seeing here is the prints on the first line consensus, those first two numbers, down 5% and down almost 33%. Those are annualized numbers, and those are the estimates so far for GDP in first and second quarter. But what you can see is all the different shops had, estimates in that range. What I think is super important is to look for the second half of the year, third quarter and fourth quarter. Everybody's expecting a rebound. When you add it all up, everybody's expecting for the U.S. GDP between 4 and 6%, depending on where it lands. And then, generally speaking, a view that we'll see above-trend growth in 2021. So the shape of recovery, this has been super interesting. Let's talk about a few data points. If we think about the S&P 500, I would argue that recovery, down that much and up within 5 months, is a V recovery. Another example of a V recovery is housing, which has come down and then moved back quickly. A U might be the economy or earnings, right? It takes some time to make their way back. The thing we want to avoid in all these spaces is the L-shaped recovery, which really is stagnation. We don't think we're going to see that. So again, different shapes of recovery for different types of data. Now, moving to some of the things we've been focused on. We published about a month ago important topics to keep in mind beyond the virus. So we mentioned Brexit, which is still going on in terms of a deal trying to be struck by the end of the year, deglobalization, of course, the upcoming election, and the policy support that we mentioned. So things that we have in focus. We almost a year ago developed a framework for the presidential election. We're in the phase that we called in that framework the general election. So we know who's running, It's time for them to announce their platforms and their proposals and time for us to review them. So we're going to be able to start to really dig into what we think the impact of these different ideas will have on both the economy, businesses, and the markets. So, of course, more to come to that. We're going to publish pretty actively as we head into the election, as you would expect. One of the areas where we think both parties will agree is U.S.-China relations. We think both Trump and Biden will signal a concept of being tough on China, but again, something that we'll watch carefully. And in fact, while it's super preliminary, as we see some of the things that they're presenting, here are 4 topics, 3 in addition to that idea of trade. So taxes, obviously what we would expect under Trump is to extend the tax cuts and maybe look for more ways to cut taxes. If we see a Biden administration, and especially a sweep by the Democrats of Congress as well, we should expect taxes to go up, especially for higher income earners, corporations, and then capital gains. On the healthcare side, I think the way I would look at it is President Trump continues to advocate for basically a market-based approach, whereas Biden obviously is leaning more towards government-supported healthcare. And, maybe a day of quote-unquote healthcare for all. So we'll see. Again, still pretty preliminary in terms of what they're publishing, but we're going to dig into it. And then finally, tech. I think what's interesting about tech is Trump is sort of focused in on fairness. He wants everybody to be heard, including himself, as it relates to tech. So he's sort of focused with the companies on that. I'd say Biden, on the other hand, is probably coming at it more from a fear of monopoly and is it fair to other companies, et cetera. So the idea of being willing to take a look at breaking up big tech. So again, the election is something that we're going to track. Here's data that sort of signals both betting odds as well as polls and even some portfolios. It's all signaling a Biden win at this point. But again, from our perspective, it's still probably, from a statistically oriented perspective, a bit of a toss-up. It's going to be very much a function of how the campaigns are run and perceptions of how the president in particular is handling the reopening and the recovery from the virus. Here's an exhibit that sort of shows all the different combinations of what might happen. Right now, interestingly, the highest probability of all these different columns is a Democratic sweep. So we'll watch that obviously very, very carefully. Now, another thing we published on a little over a month ago was the concept of 2 tails. The idea that in our scenario, we have a base case, but then a bull case and a bear case, and that it's important these days to focus on both of the tails. Here's kind of the scenario sort of painted out. And, essentially to cut to the chase, the base case is where we are. The bear case is the reopening is rough. Maybe a vaccine takes a lot longer than we think. The bull case, in turn, is, hey, the vaccine comes along quickly, people get super confident that it's going to work, and things kind of recover further as a result. And we're sitting here today saying, hey, we think the chances of one of those tails happening is higher than normal. We're watching it very carefully, and we tend to think the bull is ultimately going to unfold, meaning we think a vaccine is likely to be effective, but again, there's risk in the system for sure. Now, I've talked before about our asset allocation guidance. We had a lot of defensiveness built into our asset allocation models, the dynamic models. And about a month ago, we basically came back to neutral. So think of it as increasing our risk, we were overweight large cap, overweight U.S. We kind of reduced our overweight to large cap or our overweight to U.S., things like that, bringing us to neutral across really the asset classes. And the spirit of that isn't that, hey, we're going to stay there for a long time. We think when we move further, it'll be quickly, but it's going to be a function of whether we think the bear is upon us or the bull is upon us, back to those 2 scenarios. So again, more to come on that. I always like to close with an invitation to look at our work. We have a daily radio spot. We have, a weekly note, podcast, and video. We publish when the market's volatile. We do this video every month. We have market reviews, market perspectives is what we call it, weekly, monthly, and quarterly. So increasingly more in-depth reports depending on the frequency. Something called the Favorite 15, or our Favorite 15 slides for those of you that like to look at more concise materials. Allocation insights, our perspectives on those dynamic leanings. Our outlook, which is calendar year based, and then more foundational things like our approach to asset allocation, as well as what is called Stifel Financial ID, basically an easy-to-use behavioral finance questionnaire and model that helps you understand your behavioral preferences. So listen, thank you so much for listening this month and watching this month, this video, and we'll look forward to speaking with you after the end of the summer. Thanks so much.